SAP shares collapsed over 11% in a single session after the company missed cloud revenue expectations. And while most investors treated this as an isolated software story, what we're actually witnessing is the early fracture line in a much larger structural problem that connects enterprise spending, debt cycles, and the fragility of equity valuations built on perpetual growth assumptions. This isn't just about one German software giant stumbling on quarterly metrics. This is about what happens when the economic foundation beneath corporate technology spending begins to crack, when the credit that fueled digital transformation starts to tighten, and when the market suddenly realizes that the pricing models it accepted during zero-rate euphoria cannot survive in a fundamentally different monetary environment. The scale of what's unfolding right now in enterprise technology is staggering. SAP generates over 30 billion euros in annual revenue, serves more than 400,000 customers, and sits at the center of global supply chain infrastructure, financial systems, and manufacturing operations. When a company this embedded in the circulatory system of global commerce suddenly signals that growth is decelerating faster than expected, it's not a data point, it's a symptom. The cloud revenue miss wasn't marginal. Analysts had built expectations based on management guidance that assumed continued strong double-digit growth in cloud subscriptions, the recurring revenue model that has been the foundation of SAP's valuation re-rating over the past 5 years. When those numbers came in softer than projected, the immediate market response was brutal. But the real question isn't why the stock fell 11% in one day. The real question is what this reveals about the sustainability of spending patterns across the entire enterprise technology sector at a moment when corporate balance sheets are under pressure, financing costs have tripled, and economic visibility has collapsed. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The mechanics of how we arrived at this moment are critical to understanding why this matters beyond SAP. For over a decade, enterprise software companies operated in an environment where money was essentially free. Central banks held rates near zero, corporate borrowing costs were historically suppressed, and companies were incentivized to spend aggressively on digital transformation, cloud migration, and technology infrastructure because the cost of capital was negligible, and the narrative was that falling behind technologically was an existential risk. This created a self-reinforcing cycle. Software companies reported explosive growth, which drove valuations higher, which allowed them to raise more capital, which funded more aggressive sales and marketing, which generated more growth. The entire sector was optimized for a world where expansion was always cheaper than efficiency, where growth could be purchased with debt, and where valuations were based on future cash flows discounted at rates that assumed perpetual monetary accommodation. But that world ended abruptly. Starting in early 2022, central banks began the most aggressive tightening cycle in 4 decades. The Federal Reserve raised rates from near zero to over 5% in less than 18 months. The European Central Bank followed. Financing costs for corporations exploded. Suddenly, the calculus changed. A chief financial officer looking at a multi-year cloud migration project that might cost tens of millions of dollars and deliver uncertain returns over 5 to 7 years has to justify that spend in an environment where the hurdle rate has tripled, where access to credit is tighter, where revenue visibility is lower, and where the institutional pressure is now on margin preservation, not growth at any cost. This is the environment SAP is selling into right now, and the cloud miss is the direct result of that shift. What makes this particularly dangerous is that the market had priced SAP and its peers for a different reality. The valuation multiple expansion that happened across enterprise software from 2019 through 2021 was predicated on the assumption that cloud recurring revenue would continue growing at 20 to 30% annually for the foreseeable future, that customer lifetime values would keep expanding, and that churn rates would remain negligible. Those assumptions were built during the most accommodative monetary period in modern history. They were never stress tested against a world where corporate IT budgets contract, where CFOs demand faster payback periods, where sales cycles extend because approval chains tighten, and where competition for limited spending increases as every software vendor fights for a shrinking pool of budget dollars. Historically, these moments reveal themselves slowly at first, then all at once. In the late 1990s, enterprise technology spending was driven by Y2K remediation and the dot-com boom. Valuations soared, then the cycle turned. The Nasdaq collapsed over 75% from its peak. Enterprise software companies that had been valued at 50 or 60 times revenue fell 90% or more. The mechanism was identical. Growth assumptions built during euphoria collided with a reality where customers simply stopped spending. It didn't matter how good the technology was. It didn't matter how sticky the software claimed to be. When budgets freeze, renewals get pushed, expansions get canceled, and growth decelerates far faster than anyone modeling linear trends could anticipate. We saw it again in 2008. Salesforce, which had been growing at over 50% annually, saw growth rates cut in half within 2 quarters as the financial crisis forced enterprises to slash discretionary spending. Oracle's revenue growth collapsed. SAP itself saw revenues decline in 2009 for the first time in decades. The pattern is always the same. The technology sector convinces itself that this time is different, that software is now mission critical, that cloud models create predictable revenue streams, that customer lock-in prevents churn. Then the economic cycle turns and all those assumptions disintegrate because they were never really about technology. They were always about the availability of credit and the willingness of corporations to spend on long-term projects when the future feels uncertain. What's unfolding now has elements of both prior collapses, but with structural vulnerabilities that are potentially worse. The sheer scale of corporate debt is unprecedented. Non-financial corporate debt in developed economies is near historic highs as a percentage of GDP. Much of that debt was issued at ultra-low rates and is now rolling over into a much higher rate environment. This creates immediate pressure on cash flow and forces companies to prioritize debt service over discretionary spending. At the same time, the concentration of spending power has shifted. A huge proportion of enterprise software revenue comes from a relatively small number of very large customers. If those customers, particularly in banking, manufacturing, and retail, begin to experience their own stress, whether from recession, credit contraction, or margin compression, the impact on software vendors is non-linear. Losing one Fortune 500 renewal can wipe out the revenue equivalent of 50 mid-market wins. The cloud revenue model, which was supposed to be the solution to all of this, actually creates new fragilities. Subscription-based pricing means that revenue is only as durable as the next renewal cycle. Unlike perpetual licenses, where a customer paid up front and the software vendor recognized that revenue immediately, cloud subscriptions require continuous revalidation of value every 12 months. In a stable or growing economy, that's fine. In a contracting environment, it becomes a structural risk. Every renewal is an opportunity for the customer to renegotiate, to cut seats, to defer expansion, or to churn entirely. The financial models that enterprise software companies built assumed minimal churn and consistent upsell. Those assumptions are now being tested in real time, and SAP's cloud miss suggests that reality is diverging from the model faster than expected. Most market participants are still treating this as a temporary issue, a one-quarter blip that will normalize as economic conditions stabilize. But that perspective misses the deeper structural problem. The conditions that drove enterprise technology spending to record levels near zero rates, abundant liquidity, FOMO-driven digital transformation mandates, and a belief that technology spending was non-cyclical, those conditions are gone and unlikely to return anytime soon. Central banks are still fighting inflation. Even if they cut rates modestly, we are not going back to zero. Corporate debt levels remain elevated. Credit availability is tighter. Economic growth is slowing across most developed economies. The impulse that drove the cloud boom has reversed, and the revenue trajectories that were priced into valuations are not sustainable in this new regime. The reason this feels sudden is because markets price for continuity until the evidence of discontinuity becomes undeniable. SAP's stock didn't fall 11% because investors woke up one day and decided cloud growth might slow. It fell because the actual reported numbers broke the narrative that had been supporting the valuation. The moment the market realizes that growth assumptions were too aggressive, the re-rating happens violently. We've seen this pattern in housing in 2006, in energy in 2014, in crypto in 2022. The asset class that was previously bid up based on extrapolated growth suddenly gets repriced to reflect actual fundamentals. And the adjustment is not gradual, it's a step function. Step. What makes this particularly relevant right now is that SAP is not an outlier, it's an early indicator. Other enterprise software companies are navigating the same environment. Salesforce has already signaled slower growth and announced layoffs. Microsoft's Azure growth is decelerating. Oracle's cloud ambitions are running into competitive and execution challenges. Across the sector, the pattern is the same. The companies that were the darlings of the last cycle, the ones that re-rated from stodgy enterprise vendors to high-growth cloud platforms, are now facing the reality that their customers are under financial pressure, that budgets are being cut, that purchasing decisions are being delayed, and that the growth rates they delivered during the boom years are not repeatable in this macro environment. For the individuals and institutions holding these stocks, the implications are stark. Pension funds, mutual funds, and index trackers are heavily weighted toward large cap technology. SAP is a component of major European equity indices. When a stock this significant falls 11% in a day, it doesn't just affect direct shareholders. It affects portfolio performance, benchmark returns, and asset allocation models that assumed technology was a safe haven for growth exposure. The reflexive response is often to buy the dip, to assume that quality companies always recover, that short-term misses don't matter over the long term. But that logic only holds if the underlying growth trajectory is intact. If what we're seeing is not a one-quarter miss, but the beginning of a multi-year deceleration in enterprise spending, then buying the dip is not contrarian investing. It's catching a falling knife. The counter-argument that defenders of the sector will make is that technology spending is non-discretionary, that companies cannot afford to fall behind on digital transformation, that cloud migration is inevitable, and that any slowdown is temporary. This argument has some truth to it, but it fundamentally misunderstands how corporate spending actually works under financial stress. Yes, companies need technology, but they don't need to upgrade on the vendor's timeline. They don't need to expand licenses. They don't need to migrate to the latest platform version. When cash is tight, IT budgets get frozen, projects get delayed, renewals get renegotiated down. The idea that software spending is immune to economic cycles is a narrative that was convenient during the boom, but has never been supported by historical evidence. Every prior recession saw enterprise technology spending contract sharply, and there is no structural reason why this cycle would be different. What's particularly insidious about the current setup is how much debt is embedded in the system: corporate debt, government debt, household debt, all of it issued during the lowest rate environment in human history, all of it now rolling over into higher rates. This creates a mathematical problem that cannot be solved with narrative or sentiment. The debt service costs are rising. The cash flow available for discretionary spending is shrinking. Something has to give, and historically what gives first is spending on long-term projects with uncertain payoffs, which is exactly what most enterprise software investments represent. The acceleration phase, the part that catches people off guard, happens when multiple pressures converge simultaneously. Right now, we have rising debt service costs, slowing economic growth, tightening credit conditions, and deteriorating corporate profit margins all happening at once. Any one of these in isolation would pressure enterprise spending. All of them together create a compounding effect that is far more severe than linear models anticipate. This is why the collapse in 2002 was so much worse than people expected in 2000. This is why 2008 was worse than models predicted in 2007. The system doesn't degrade linearly. It degrades exponentially once critical thresholds are breached. For real people, the transmission mechanism is employment and portfolio values. When enterprise software companies miss revenue targets, they cut costs. That means layoffs, hiring freezes, and reduced compensation. We've already seen this begin across the sector. The workers who were hired aggressively during the boom, the sales teams, the customer success managers, the implementation consultants, are now being let go because the growth that justified their hiring has evaporated. At the same time, the equity compensation that was a huge part of total comp for these workers is collapsing in value. Stock prices that were up fivefold from 2019 are now giving back those gains, which destroys household wealth and reduces consumption, which further pressures the economy, which further reduces corporate spending, which accelerates the cycle. The objection that this is all too pessimistic, that economies are resilient, that central banks will step in, that fiscal policy will provide support, misses the point entirely. It's not about pessimism or optimism. It's about incentives and structure. Central banks cannot return to zero rates without reigniting inflation, which they have spent the last 2 years trying to suppress. Fiscal policy is constrained by existing debt levels and political gridlock. The idea that there is some safety net that will prevent the natural consequences of overleverage and overvaluation from playing out is comforting but not supported by the mechanics of how these cycles resolve. They resolve through destruction of excess capital, through defaults, through layoffs, through asset price declines, and through the painful reallocation of resources from unproductive uses to more sustainable structures. What we are watching with SAP is not the cause of the next crisis. It's a symptom of forces that have been building for years. The mispricing of risk during the zero-rate era, the overinvestment in business models that only worked with free money, the assumption that growth could be infinite as long as the narrative held. All of that is now being tested, and the early results are not encouraging. When a company as established and embedded as SAP, with hundreds of thousands of customers and decades of operating history, cannot meet cloud growth expectations in an environment where digital transformation is supposedly mandatory, it tells you that the problem is not execution. The problem is demand. The problem is that customers do not have the budget, the confidence, or the institutional willingness to spend at the rates that were priced into equity valuations. The convergence point, where all these pressures reach critical mass, is not some distant hypothetical. It's unfolding in real time. Corporate earnings are being revised down, credit spreads are widening, liquidity in certain markets is deteriorating. The financial system is not collapsing in a dramatic single event. It's grinding down through 1,000 small breaks, each one individually explained away, each one treated as idiosyncratic, but collectively forming a pattern that anyone who studies financial history recognizes immediately. This is what the early stages of a major repricing event look like. It doesn't start with Lehman Brothers. It starts with earnings misses, with margin compression, with small cracks in the narrative that investors had convinced themselves was unbreakable. The path forward from here is not mysterious. If corporate spending continues to weaken, more software companies will miss, more stocks will reprice, more layoffs will follow, portfolio losses will compound, consumer spending, which is driven significantly by wealth effects, will contract. This will further pressure corporate revenues, which will lead to more cost cutting, which will accelerate the cycle. The feedback loops are all negative now. The question is not whether this happens. The question is how far it goes before some stabilizing force, whether monetary, fiscal, or simply exhaustion of selling pressure, arrests the decline. But stabilization, when it comes, does not erase the losses. It does not undo the wealth destruction. It simply marks the bottom from which the next cycle begins. And that bottom is always lower than anyone expects, while the decline is still underway. SAP's 11% single-day collapse is not the warning, it's the confirmation. The warning was 2 years ago when central banks began tightening, and anyone paying attention understood that the financial conditions that supported the technology boom were ending. The confirmation is now as the real economy catches up to the monetary reality, as corporate budgets reflect the new cost of capital, and as equity valuations built on assumptions of perpetual growth meet the hard reality of cyclical contraction. What happens next is not speculative, it's structural. Systems under this much stress do not stabilize, they break. The only question is how much capital gets destroyed in the process.